Good afternoon, ladies and gentlemen. Thank you for taking time out to come in for this masterclass on currency forecasting and Forex hedging. I extend my thanks to the team at Inventicon for giving me this opportunity to present before you. I know that there are several very senior and seasoned participants, members in this summit. So I hope that whatever I have to share with you, I intend to share some of the best tools and insights that we've gathered over the last 25 years of our operations. I hope that these will be of interest to you, to everybody in the summit. And since this is a class, I would, with your permission, want to start with an invocation. If you know it, please do join me. Om Sahana Bhavatu Sahanau Bhunaktu Saha Viryam Karvavahai Tejasvinavadhitamastu ma vidvishavahai. Om Shanti Shanti Shanti. This is an invocation for blessings that our interaction should be very fruitful. So let us start the master class on rupee forecasting and Forex hedging. Now, why are we talking about forecasts? Because businesses, I believe, very sincerely run on projections and forecasts. Without them, there would be no business. And we also believe that Forex is your business. There will be more about this when we talk about hedging in the subsequent section. The first section will cover forecasts. And if Forex is your business, then currencies have to be forecasted. Now, the good news is that dollar rupee can be forecasted. I know that this possibly goes against the commonly held notion that currencies like the weather cannot be forecasted. But here I'd like to share with you a chart on the reliability of the 7-day UK weather forecast from 1980, when it was 45%, and then it increased to something like 72% by 2015. And our own dollar rupee forecast reliability chart, which was less than 35% in 2006. And from there, it had increased to 72% in 2017. And now we are at around 74%. So the important thing is that contrary to popular notion that weather forecasts and currency forecasts are unreliable, we actually are at a place where both are now quite reliable to an extent that we can use them for our business purposes. And both of these improvements have been made possible by more data, by more study. And I intend to share some of these with you in this session. But before that, I'd also like to share with you something that we call the 4 T's of a good forecast. What are the 4 T's? The first is the trend. What is the market direction? Market kahan jayega? What is it looking like? Kahan jayega? Then the second is the target. Till where will the market go? Kahan tak jayega? Now, these are the 2 questions that most people ask and most people also try to answer. Okay. The third question is time. By when? Kab tak jayega? This is a question that fewer number of people ask and even fewer answer. And the 4th T is the trail. What path will it follow? Will the market first go up before it goes down, or will it first go up? Go down before it goes up? What is the path that it will follow? Will it go straight up or go straight down? This is the trail. So these are the 4 T's. The time and the trail are not asked by most people, and very few people try to even answer this question. Here is something that we do on a regular basis. This is a forecast that we made on the 4th of August 20 last year, when dollar rupee was 75.14, and we gave out hard number forecasts for each month going out to the next 12 months. So for August 20, September 20, October 20, so on up to July 21. So August 20, we said that the highest that we expect is 76 quarter. The lowest might be 74.70. Our preferred or the most probabilistically possible level that we were looking at was 75.57. And an average of these would be 75.61. Similarly, a number for September, another number for October, so on for each month. So hard number forecast for each month going out to 12 months. Now, this is something which covers the 4 T's: the trend, the target, the time, and the trail. So you can see that we're looking at a downtrend, but then it goes up later on. It's not a straight line. Okay. Now these can be put into Excel for budgeting and hedging decisions. And once we put our numbers out, we are not afraid to be wrong. All that we are looking at these forecasts are going to be evaluated against actuals later. And this is in fact what has helped us to go from the 32% reliability to 72% reliability over the last 15 years. Now, how do we do this is what I'm now going to share with you in the tools, the forecasting tools that we have. I'm going to share a number of charts with you. So the first chart that I'd like to share with you is a very, very important chart, one of the best charts that I could ever show to you. This is using long histories along with log charts and Elliott waves on crude. This is a study that we done in April 2019 when Brent was 69.71. And we said that Brent might drop to $60, $55, or even to $33 by 2020. We all know that crude actually did drop to $15 1 year later in 2020 due to the coronavirus pandemic. But imagine being able to say that 1 year in advance. How were we able to do it? So this is a chart of yearly averages. So each point is the yearly average, a chart from 1928, and each value has been plotted as a log value on the log scale. This is not a nominal chart or a normal chart, it's a log chart. And when we plot this, we can see a possible 5-wave structure of Elliott wave. The first wave being a rise to $1.99 in 1948, then a sideways correction, a slight downward correction to $1.8 in 1970 as wave 2. Then a rise to $36.83 in 1980 as wave 3, fall to $12.72 in 1998 as wave 4, and then a rise to 111.67 in 2012 as wave 5, completing a historic up move of crude. And thereafter, of course, there has to be an ABC correction. So an A happened in a fall to 43.73 in 2016. Then there was a B, and then we projected a wave C coming down to 3.5 on the log scale, which gives us $33.11. And we anticipated that this would happen by 2020 or max by 2021. And then we found that it actually did happen in 2020. So 1 year in advance, we were able to figure out the direction, the target, and a possible time for crude using long histories, log charts, and Elliott waves. So this is the first chart that I wanted to share with you, one of the most important charts. Second, similarly, long histories, Elliott waves, and log charts on Rupee. This is again the same time we done. This was April 19. Dollar rupee was 69.1650, and we said that we might get one last rally to, we might get one last rally to 77.5 before dollar rupee depreciation comes to an end. Here, this is a monthly chart. Earlier one was a yearly chart. This is a monthly chart, and here again we can see a 5-wave structure. Basis this, we said that possibly if the market goes up to 4.3 on the log chart, which would be around 77.5. And imagine in April 19, we were able to figure out a possibility of 77.5 1 year down the line. Okay, made possible by long histories, log charts, and Elliott waves. So these are the tools that you can use, the tools that I'm sharing with you. Third chart, again long histories and Elliott waves, but now a nominal chart, not a log chart, on the 10-year GOI yield. This is in January 20. The 10-year GOI yield was 6.56%, and we said that there's a chance of it coming down to 5.75%. And we know that the GOI has, in fact, then thereafter did fall to 5.75, and now we're at 6.25%, something like 6.3, on the basis of a simple reading of a triangle, 1, 2, 3, 4, 5 legs of a triangle, which would then devolve down to 5.75. So 3 charts so far using long histories and Elliott waves. Then we go on to a 4th chart. Now this is a very, very interesting chart using fundamentals, US data, and correlations between them. The green line out here is the US consumer confidence on the left axis, and the employment rate, the pink line, on the right axis, the employment rate just being the inverse of the unemployment rate that we are all used to seeing. So this study was done on 5th of March 20, and we saw that both of them firstly are beautifully correlated, and both of them were at multi-year peaks. So we said that there are chances that they could fall in 2020, especially due to the coronavirus. Okay, so the use of fundamentals and correlations together. This is another thing that I want to share with you. Right now that we've looked at these fundamentals and correlations, the next chart that I would like to share with you is very, very interesting. And here, this chart, I really want to go beyond the the normal debate about fundamentals versus technicals, etc. This is a use of fundamentals and statistics and correlations on US data and the Dow Jones. This is a study on the 5th of March 2020. The previous chart that we had seen was the US consumer confidence index level itself. Now this chart, we have the US consumer confidence, the green line, as the year-on-year change on the consumer confidence, and the Dow Jones year-on-year change. They are plotted together, and we see a beautiful correlation between them, especially since 1999. Okay, how beautiful is this correlation? And if in the previous chart we were looking at the US consumer confidence coming down, when we look at this chart, then we can say that the consumer confidence year-on-year change will come down towards minus 20%. Basis that, we were able to say that the Dow Jones, which was then at 26,350, we were able to say that if the US consumer confidence falls, then it will drag the Dow down to 22,000 by September. Okay. And let me now take you to the next chart. Now let's see what actually happened. The Dow Jones actually fell by the end of March 20, within March 20 itself, to a low of 18,213 because the coronavirus hit big time. Okay, but now this chart is again a very long history using log charts and trend lines. It had fallen. This is a chart of the Dow Jones since January 1900. Okay, and on this, when we draw trend lines, this trend line coming up from 1982, joining the post GFC low of 2009, that gave us a support at 9.9 on the log chart, and a fault line coming up from the Y2K high of 1999 and the pre-GFC high that gave us a confluence around 9.9, and this is exactly the level of 2013 that the low was hit in March 20. So when we saw this, we were able to say that there could be chances of a bounce from here at a time when everyone was very, very bearish. A long-term history using log charts and simple trend lines alerted us to the possibility of a bounce in the Dow, and therefore that there could be chances of a bounce in the Sensex also, and that therefore the dollar rupee could fall. So this is something, again, long-term histories help us with. Okay, I'd now like to bring you to something that we use quite often, invented time frames. This is a time frame, a bi-monthly chart that we've actually invented. So bi-monthly is a 2-month chart between a monthly and a quarterly chart, and this is when we say this, we're using very large time frames, instead of just dailies or weeklies. So large time frames, bi-monthly chart that we've invented along with trend lines. This is a study that was done on 1st of June 20. Dollar rupee was 75.35. That come down from a high of 76.91. That 76.91 on this bi-monthly candle chart, we figured out was a false break. And therefore, with the use of simple trend lines, we said that there was a chance that dollar rupee could come down to 72. And you know what dollar rupee has done after that? So again, a 1 year ahead forecast based just on long histories and large time frames. So the important thing that I'm telling you is long histories, large time frames. Okay. Next, let's move on to the next chart. Again, large time frame quarterly charts, quarterly candles. This we're using on Brent. Okay. Here we have, this was done on 8th of March 21 when Brent was 69.36, and we said that it could fall from 75, 77. So we went up to about 77 or 78, and thereafter, you know that we have started falling, and this is the view that we currently hold, that Brent can come down towards 55 over the next 3-4 quarters. Okay, so a simple, see, why am I sharing this with you? There was so much of talk of 80, 85, and even 100 on crude, and I think people just don't maybe look at long histories. If you just draw a simple trend line on a long-term chart, on a quarterly candle, it just tells you that there's very little chance of this going beyond 75 or 77. That's all that we've done. Okay, so that is large time frames on Brent giving us a good forecast. And now this is yet another long histories using rupee crosses on dollar yuan and punching that in with dollar rupee to give us yuan rupee. This was done on 8th of March 21. The blue line is the dollar yuan from 1970. It rose from a level of, say, on the, this is the yuan is on the left hand axis. It rose from a level of, say, 1.5 to in 1980 to 8.8 in 1994, and this uptrend has clearly been broken. After that, we've got a good top here at 7.2 basis this, and then it had come down, and there was a support coming up on this shorter time frame, and basis this we figured that there could be a support at 6.4. There was a false break below that, and thereafter now the market is trading at just below 6.5. If we look at this chart, there it would seem that there are chances that this goes up to around 6.8 or maybe even 7. If this happens, the normal reaction that we would have is that if the yuan is going to weaken, then the rupee is also likely to weaken. But if we look at the yuan rupee chart, which is the green line on the reverse scale, here we've got on the right axis, reverse scale from 2.5 to 12 out here, which means that the rupee has actually been depreciating against the yuan since 1971 to a point that it has come down to 11.6. We have a resistance here at 11.6, 11.5. And if the yuan is going to weaken towards 6.8 or 7, a lot of that will be reflected as a fall in the yuan rupee from levels of 11.6 or 11.5 towards 11. So a lot of the yuan weakness, possible yuan weakness, can get digested, so to say, in the yuan rupee rate, so that the dollar rupee itself might be relatively stable around 75.25. This is something how we are able to figure out dollar rupee from yuan rupee, instead of, if we were to just look at yuan rupee and say that, dollar yuan, and say that if the yuan is going to weaken, then the rupee has to weaken. But no, this tells us that there's a possibility that the rupee might not weaken so much. Okay, so again, long histories, but with crosses on the rupee. After having looked at the rupee like this, I'd now like to share some very interesting charts with you. This is a combination of fundamentals, market variables, correlations, and statistics on the Brent and how it correlates with the global GDP. So here we have a chart of the year-on-year movement on Brent. So it's not just the Brent chart, but the year-on-year movement on Brent on the left axis. And this we correlate with the global GDP data as given by IMF. And we see there's a beautiful correlation between the two of them, except for this period in around between, say, 2012 and 2018 or so. But when we saw in April 20 that Brent has fallen dramatically, then we were able to figure out then that obviously the global GDP would also fall due to the virus, due to the pandemic. But thereafter, we figured that there could be chances of a good bounce in the Brent to around a 40% rise in Brent from the low, and that could also take global GDP up. So here, as I said, we go beyond the the debate on fundamentals versus technicals, and how Brent can help us figure out GDP. Next chart that I'm going to share with you could be a little intense, okay, but I'm sure that you might, I hope that you will enjoy it also. This is, if you see the first chart here, is a correlation of the US 10 line on the left axis, the US CPI, which is the red line, again on the left axis, and Brent absolute price on the right axis. And we see that there's a relatively decent correlation between them over time, especially from, say, 2015. And this is a study that happened in May 2021, this year. From March 20 last year, Brent had moved up, US yields had moved up, and of course the US CPI had moved up, that we know. But you see the correlation between them. And this correlation between US CPI and the US yield is brought out more clearly out here when we take away Brent. Now, why I'm using this is because I've shown you earlier on the Brent quarterly candle chart that we are bearish on Brent. So if we are bearish on Brent and we see Brent coming down towards $55, then the US CPI, which has gone up to 5.25% or so, we think can also come down, and therefore we are agreed with the Fed that the inflation is more transitory than permanent. And this, when we keep in mind and we look at the next chart, this is a very long-term history on the US 10-year since 1977, when the 10-year was something like 15.6%. From there, of course, we came down to 0.5 in the pandemic. Okay, but see this inner trend line. When we see this inner trend line, this came up to say around 1.75, 1.8. We were able to say, because of our view on the Brent, that it would come down, it would not go up beyond 75, 77 or $78, that it would come down towards $55. We've seen that it has come down to 70. We were able to say that only in case Brent goes up beyond $80, would the US 10-year go up to 2 or 2.25%. And if Brent stays below $80, then there's a good chance that inflation will be transitory and that the 10-year would fall. So this is how we are able to combine fundamentals and technicals together to have a good view on the markets, using Brent, using the treasuries, putting them together, figuring out inflation, and therefore also dollar rupee. Okay. So the tools that I have shared with you, 10 tools that we have, are for reliable dollar rupee forecasts and long histories, the use of log charts, the use of Elliott waves, of course, and of course trend lines. I've not mentioned that here, but trend lines, we can't live without trend lines. Then large time frames, monthlies, bi-monthlies, quarterlies, instead of only say dailies or weeklies. And then self-invented chart. We actually invented a 3-day chart, which is a bridge between a daily and a weekly chart, a 13-day chart, which is a bridge between a weekly and a monthly chart, and a bi-monthly chart, which is a bridge between a monthly and a quarterly chart. Then ratio charts, we use a lot of ratio charts. I've not featured them here, but something like, say, a Sensex by Dow ratio, or a Sensex in dollar terms. Those would be ratio charts, which we use a lot of times, all the time, in fact, and correlations. And then we look at many variables. Today, you've seen crude, Dow, Sensex. We all use Indo-US yield spread, or the ADXY, and the yuan rupee, or the euro rupee. In fact, we look at about 55, 60 variables. The use of fundamentals, you've seen that. And most importantly, no fear of going wrong. These are the tools that we use to come up with reliable dollar rupee forecasts, which I hope would be useful to all of you as well. With this, now we come to the end of the first section, and we will move on to the second section, which is hedging. Okay. Right. After having shared some of the tools that we use for forecasting rupee, let us now move on to the second section of our masterclass, which is on Forex hedging, because eventually the benefits of the forecast have to flow into practical Forex hedging. The issues that I want to cover in this section are, first, some ground realities about hedging. Secondly, net hedging or natural hedging versus gross hedging. Then third is the calculation of net effective exchange rate. Fourth, the results of the Kshitij hedging method over the last 15 years. And then finally, comparing different strategies, hedging strategies for importers. So the first ground reality that I want to talk about is Forex. We believe this very fervently, that Forex is your business. Why? anything that impacts your business, manpower, raw material costs, manufacturing costs, even interest rates, is your business. By that same logic, therefore, managing Forex risk is your business. Secondly, Forex hedging is pre-facto, and accounts, on the other hand, is post-facto. We all know that businesses run on budgets, and similarly, Forex hedges run on forecasts. Thereafter, when things are done, a variance analysis is undertaken, and the budgets and the forecasts are compared with actuals. And the reasons for the difference is analyzed, and corrective action is taken in the next cycle. This is how businesses run. Accounts are then written afterwards. So accounts are post facto. So making Forex hedges adhere to the dictates of accounts is actually standing logic on its head. Now, I know that what I'm saying might be different from what is normally heard or talked about, but this is a ground reality, because I'm coming at Forex hedges from a very common sense business point of view, and where I say that Forex is a cash business. Because we might not be looking at our Forex departments, the Forex desk, as a profit center. But can I save money through Forex? Because money saved is money earned. And when I have got healthy cash profits, then only it can lead to healthier accounting profits. So this is something we have seen, that there is scope for saving money in Forex. Okay. And for that, these are the ground realities that we have to look at. Another ground reality when working in Forex is there is often a dilemma as to what to use for making our budgets. So we say that forecasts are better for budgets than forwards. So let's have a small face-off between forwards or forecasts. What should we use for our Forex budgets? If we take the issue of unambiguity, then definitely a forward is a better rate, because it is a single rate, it is unambiguous, it is commonly known, and it easily passes auditor scrutiny. Whereas there can be many forecasts which are all possibly contradictory, and therefore they're all confusing. So it might be better to use a forward rate. And this is the reason that people do prefer to use a forward rate. But if we look at impartiality, then we know that forwards are advantageous to exporters, because exporters, they receive premium, and the forward is disadvantageous to importers because they pay premium. Now, it would be all right if there was a company had only exports or only imports. Okay, but what does a company do when it has both imports and exports? Then what does it do? A forecast, on the other hand, is impartial to both. So here we find that a forecast is better than a forward rate. And if we talk about whether the rate is an indicator of the future, because we got to pay or receive in the future, we can clearly see that no, forward rates are based on the current spot. Forwards are spot plus forward premium. Forward premium is just the interest rate differential. So they are actually functions of current spot. So they are not indicators of the future. Whereas a forecast is not related to the current spot. It is a direct indicator of the future. So the only advantage going for forwards is that they are unambiguous. The forecast does better on the other two counts. So our suggestion is to use reliable forecasts like ours or anybody else. Okay. If you've got reliable forecasts, you use that for your budgets, for making your annual Forex budgets or even your hedging decisions. Okay. Now, this is a very important topic, is natural hedge versus gross hedge. Which one is better? We all know really that natural hedge is actually a myth, because it doesn't exist in reality. It exists only in theory. And we also say that it doesn't pass the common sense test, and that is it is unprofitable. But before I go more into that, let us take a look at a small video. Okay.
Say there is a small ration shopkeeper who buys and sells rice or wheat the whole day. We could say that he has a natural hedge in the rice or wheat that he buys and sells. Does he not try to make a profit margin between the rate at which he buys and the rate at which he sells? If a simple ration shopkeeper can work on this very basic business premise, surely the sophisticated forex hedger can also do it.
So we saw that how an ordinary ration shopkeeper works on the simple business logic of trying to buy at a lower rate and sell at a higher rate to make that profit margin. And that is what we call gross hedging in the context of Forex. And we say that it works. How do we say that? Let us look at data. First, I share with you, these are actual numbers for a company from the period April 2013 to October 2019, more than 6 years, 6.5 years or so. During this period, the company bought imports worth $3 billion, and the average rate that it paid per dollar was 65.20. At the same time, during the same period, it also had almost a perfect natural hedge. It exported worth $3 billion. And the rate that it sold at per dollar was 65.05. So if we look at the rate difference between the rate at which it bought dollars and it sold dollars, that comes out to a negative 15 paisa. 65.20 minus 65.05. So there was a net total loss of 48 crores, which comes out to be a monthly loss of 60 lakh rupees or an annual loss of 7.2 crores. Now, the funny thing is that this loss is possibly not revealed through accounts. And also funnier is that this loss is possibly not even being looked for, because natural hedge is assumed to be all right. That if I have a natural hedge, then I don't need to do anything. Okay. So the whatever forex profit loss is there will be there even in accounts as forex profit loss, but the rate difference between what we paid for our imports and what we paid for our exports, that doesn't come up. Okay, so we find that in natural hedges there is a good chance of losses. This is for 6.5 years. This is real data. In contrast, let me share with you real data for a much smaller company for the period October 2020 to March 21. In this period, this company had imports of $4.5 billion, for which it paid 73.26 per dollar, and exports, much larger exports, but the equivalent amount, if we take $4.5 billion, it sold exports at 73.71. So there was a net positive difference between the buying rate and the selling rate of 45 paise, or a total profit of 20 lakh or a monthly profit of 4 lakh. Now, the profit amount absolute does not really matter, because that is a function of the base amount. Here it is $4.5 million, whereas earlier it was $3 billion. What is important is that there is 45 paise positive difference between the buying selling rate out here under gross hedging, and there was a 15 paisa loss between the rate of buying and selling under a natural hedge. So net there is a 15 plus 45 paisa, 60 paisa difference. So companies which are which have both imports and exports, they really need to look at this. If you're already following whether you're following a natural hedge system or are you doing gross hedging. If you're following natural hedge, how much money are you leaving on the table? Okay, there's a potential that we see here of 60 paisa as the delta. Okay. Now let me share with you this period. You can say is a very small period. Let me share with you the results of the Kshitij hedging method over the last 15 years, 15 plus, from April 2006 to July 2021. During this period, import payment rate average was 57.85% and export realization rate was 58.27%. Now this includes all forward cover option costs, everything, all hedging costs and all forecasting mistake, everything is covered out here. That said, we got a rate difference of 42 paisa per dollar between 57.85 we paid for imports and 58.27 we got for exports. So that's 42 paisa or 0.73% of the import rate. So the companies that have both imports and exports and believe in natural hedge should possibly do a serious rethink. Are they leaving money on the table? How much does a 60 paisa per dollar mean to their bottom lines? And see, I'm not talking any theory here. I'm talking real, plain, actual data. Okay. So I'm not going in for any textbook. I'm sharing with you what we have actually worked with, and these are real numbers. Now, a small point on the calculation of a net effective hedge rate, which is essential for performance measurement. It is also essential for comparing different strategies and systems. So how do we do this? Calculate a net effective rate. Say you take the, if you're an importer, you would have paid, and if you're an exporter, you would have realized. So how much have you paid at spot? Say that's $3 million and you paid it at a rate of 74.20 average. And you had various hedges, forwards, options, calls, or some were exercised, some were not exercised. That was say $7 million at an average, weighted average rate of 75.20. So that gives you for $10 million, you have a weighted average rate of 74.90. Then suppose there was some trading cancellation profit loss, suppose amounting to a loss of say 10 lakh rupees. That gives you a cancellation, a trading loss of 10 paise per dollar. So the net effective rate for exports becomes 74.90 minus 10, 74.80. And for imports, it becomes 74.90 plus 10, 75. This can be compared with the market rate that prevails on the realization day, on the exposure retirement day, that suppose is 74.20. Then we can figure out whether it was beneficial to have hedged or not to hedged. So this is how to compare, to calculate a net effective hedge rate. Why I'm sharing this with you is that many companies were not doing it. Even the very large companies were not doing this till some years ago. Now I'm very happy to note that many more companies are doing it, and certainly most of our clients have started to calculate this net effective rate. Now, why is that important? Because it helps us to compare systems. And here I would share with you, earlier I had shared the results of the Kshitij hedging method in summary over April 2006 to July 21. And here are the details, annual results of the Kshitij hedging method from 2006 to July 2021. Here we find the export realization per dollar is 58.27 and the import payment rate is 57.85, giving us a 42 paisa positive spread between the export realization rate and the import payment rate, or 0.73% of the import payment rate. Now, some more interesting things out here are this 58.27 under the Kshitij hedging method, which is a combination of forwards and options and forecasts. 58.27 has been better than just selling plain forward. That would have got us 58.19 on exports if we just sold forwards. Okay, so this is better than plain forwards, and 57.85 is 57.85 is of course much better than buying forwards. That would have costed us 58.19. But if we had comparing with the market spot on realization date, that is an average of 57.71. This tells us that if we had not hedged at all for imports, so the importer had not hedged at all, he would have paid actually 57.71 compared to what he has paid 57.85. Okay, so he's actually paid 14 paisa more by hedging. All right, so this tells us in summary over a period of 15.5 years that number one, the exporter should go ahead and hedge because we know that we receive premium. The importer, on the other hand, we can say in summary that it might have been better not to hedge at all. This is something that might strike as something very strange. How come in a depreciating rupee environment we don't hedge imports? But this is what the data is showing, that the cost of hedging has actually been more than the benefit of hedging. I mean, if we had paid less than the market, then it would have been better. But we've actually paid more than the market. Okay. So it also tells us that hedging for imports is more challenging, way more challenging than hedging for exports. This all of us know who are managing exposures. This brings me to the next section, comparing strategies for importers. This is a study we've done for Company X over different periods, April 2006 to March 20. This is on the Kshitij hedging method. Then what we got for client A for a period August 19 to March 20 or August 19 to May 20, and what we got for client B, client A and B being different from Company X. Okay. Under the Kshitij hedging method, over a long period, we paid 56.29. And if we removed options from the Kshitij hedging method, we would have paid 56.12. This 56.29 can be compared with doing systematic forwards for a period of 3 months, buying forward up to 3 months for 30% of the exposure. That would have given us 56.30. The market spot during this period was 56.15. This we find here, and if we done Kshitij hedging method without options, discretionary forwards up to 54% of the exposure, we actually paid less than the market, 56.12 compared to 56.15. So 3 paisa by doing discretionary forwards. Okay. Yeah. So this is something that strikes us. People say that no, we got to be only systematic, but when we're trying to save cost, a 3 paisa for very large importers is also, I mean, you've saved on the market after hedging. Now, for client A, we found that discretionary actuals, these are actuals that we did. Actual results 71.19 against a market spot of 71.66. And for this period 72.09 against market actual of 72.51. So we actually did better through discretionary forex hedging than by leaving it open for the market. And of course the Kshitij hedging method was much more expensive in that period. Okay. And for client B, we saw that we would have paid 66.12 under discretionary hedges as against a market spot of 65.88. So this period, leaving it unhedged would have been better. Of course, the Kshitij hedging method was way more expensive. And so this I'm sharing with you that how we are comparing different strategies for importers, because hedging for importers is more challenging, because we got to try and work, how do you save hedging cost and not be open to risk also at the same time. And here, recently we've done a study for company Y, comparing, this is for the period January 17 to 21. Okay. The company's own effective payment rate per dollar in this period has been 70.17. If we had not hedged at all, then the payment rate would have been 69.94. The Kshitij hedging method during this period, we would have paid 70.43. And during this period, the effective rate that we have got for hedging, after hedging for other importers, this is real data, is 70.05. So what it tells us is that our readings are that, number one, it might have been best not to hedge at all, then we would have paid 69.94. And the Kshitij hedging method, which is a combination of forwards and options, was the worst performing system at 70.43. The company's rate was better than the Kshitij hedging method, that is 70.17. But the discretionary hedges by Kshitij were even better at 70.05. So that's 12 paisa saving over the company's rates. And that on the company's exposure turns out to be a potential monthly saving of about 10.5 lakh rupees. So what we find for importers, what emerges so far for hedging for importers is that either we should not hedge at all. So we should pay at spot. Okay. But then we have to live with periods of high volatility, and the danger there is of that the management might panic and hedge at high rates of dollar rupee, like hedge, go in and buy forward at 76.5 on dollar rupee or at 76.75 or something. Secondly, options are definitely not worth it. Of course, for exporters, if you buy a put, you're paying for premium instead of selling forward where you receive premium. So that's a no-brainer. But even for importers, the cost of the options we've seen, which are included in the Kshitij hedging method, it's not worth it. So what do we then do? The best solution that we have found for hedging imports is to hedge on discretionary basis using our forecast, the Strategist.com forecast, and our hedging advice. Now, this is what, I'm not saying this just to sell our services, but this is what we are found on the basis of data by comparing different systems and what we are doing for our clients. So the hedging advice capability that you can make use of is that we have a 15-year track record of our forecast. So what we said, that can be made use of for comparing systems and building strategies. We also have 15 years of hedge advice data that we ask importers to buy or sell. What did we ask importers, exporters to do? We have data available on forward premium and on option costs at various strikes for puts and calls for periods from 1 month up to 12 months. So we can compare between different hedging strategies over long periods of time. And that can help you to adopt an effective hedging strategy based on data, not on suppositions, on actual data. And there's no back testing. This is all things that have been done in real time. Okay. And such a strategy then can be followed by a company with greater conviction instead of paper FX policies that are never followed. Okay, so this is something I'm sharing this with you because this is what you who are running very large companies or large treasuries might be wanting to look at. It's not hedging tools, but how do we hedge comprehensively in a better manner? Which system is better? What works over a long period of time? That is something that we can try and figure out. So I've shared with you the Forex forecasting tools that we use and what we've learned on hedging strategies over the last 15 years. Maybe I have rushed through many things. I have tried to cover as much as I could in a short time. If you have questions, I'd be very happy to take them in the question answer session. And even afterwards, if you'd like to write, you can write to me at vikram@kshitij.com or reach out to me on my phone. So these details are there with you, or through Inventicon, you can do that. The team at Inventicon is very helpful. And once again, Thank you so much for taking time out to come in today. Thanks to all of you, and thanks also to the team at Inventicon. I'm available for question answers as they come in. Thank you so much.